G'day and welcome back. If you are joining us for the first time, welcome to Dispatches from the Outpost. I'm Brennan, founder of ATS Trading Solutions, and this is episode 6, and it is the start of something we've been building towards since episode 5. Now, in episode 5, the Fractals of Finance Phase 1 proved that financial markets carry a statistical fingerprint that the random walk forbids. Across 68 futures markets, 8 asset classes, 6 continents, and 41 years of data, the evidence was unanimous. Markets have memory in their volatility. The Hurst exponent averages 0.866. 5 sigma events occur 5,791 times more often than the bell curve predicts. The fingerprint is universal and feedback is the mechanism. But phase 1 was a photograph, a cross-sectional exposure of a moving system. It told us what was there, but it did not tell us what it was doing. So phase 2 asks the deeper question. Not whether feedback exists, but what it does over time. Not whether the machine is running, but whether it is speeding up or slowing down. Not just that the fingerprint is universal, but what it means structurally for every asset class, every regime, and every trading approach. So we start with the single most important number in quantitative finance, 0. So let's go. ATS Trading Solutions has been producing content about systematic trading, trend following, and outlier hunting since 2014. And one idea at the centre of it? Long-term success in markets comes from understanding proven professional processes, not tips, not predictions. Every dispatch is built on published ATS research. Every episode has a full blog post on the website. Written summary, links to the original series, key takeaways. The link is in the description below. This dispatch for episode 6 walks through the Fractals of Finance Phase 2. 9 episodes, 1 sustained investigation into what the feedback fingerprint actually does. Phase 1 proved the fingerprint exists. Phase 2 asks what it means. 9 episodes, each one builds on the last. The argument is cumulative and progressive. You cannot really skip to the end. Let me take 60 seconds to set the stage, because understanding what Phase 2 investigates requires knowing exactly what Phase 1 proved. So Phase 1, Episode 5, established 7 independent lines of evidence. Markets carry memory in their volatility magnitude. Across 68 markets, the Hurst exponent averages 0.866, which is higher than the Nile River that inspired the measurement method. 5 sigma events occur 5,791 times more often than the Gaussian model said they should. The statistical fingerprint is universal across every asset class on Earth, and a controlled agent-based simulation proved that feedback is the mechanism. Remove divergent agents and the fingerprint vanishes. Restore them and it returns. Phase 1 answered the question, does the machine exist? It does. But Phase 2 asks the next question, what is the machine doing? The central claim of Phase 2 is this. The near zero autocorrelation of daily returns that everyone in finance takes as confirmation of the random walk is not what they think it is. It is the weighted average of 2 opposing forces that cancel when you compress them into a single number. Positive feedback makes price moves persist. Negative feedback makes them reverse. These 2 forces are permanently present in all 68 markets simultaneously, and their balance determines everything, whether a market trends or chops, whether trend following works, and why crisis alpha exists. That is what we are here to investigate. 0. Not as a result, as a clue. Take the S&P 500. Compute the first-order autocorrelation of daily returns across 42 years, more than 10,000 trading days. The answer is negative 0.07, indistinguishable from zero. If you presented that number to a risk committee, they would nod and move on. It confirms what everybody already believes. The S&P 500 has no exploitable serial structure. The random walk therefore holds. Across all 68 markets in the dataset, the picture is the same. The mean full sample autocorrelation is negative 0.001. 68 markets, 8 asset classes, 4 decades, the answer averages to zero. This is the foundation on which modern finance was built: the efficient market hypothesis, the random walk, the capital asset pricing model, value at risk, Black-Scholes. All of them rest on the premise that this zero means the past is irrelevant. One point of precision: the near zero full sample average does not mean directional persistence never exists. It means directional episodes are regime dependent and opposing regimes cancel each other when you average across time. This series is not a claim that tomorrow's sign is trivially predictable from today's. It is a claim that the zero conceals two structurally distinct states, and that understanding those states separately changes everything downstream. The zero is real, but it is not what everyone thought it was. It is the weighted sum of two opposing forces that cancel each other when you compress 40 years into a single number. Beneath the zero lies a machine, and it has been running unchecked for 4 decades. Before we get into the 9 episodes, one foundational idea that underpins everything that follows. Jean-Philippe Bouchard and his collaborators at Capital Fund Management established something that should have rewritten the foundations of financial theory. The only force that moves price is the physical act of trading itself. Every order placed, every position sized, every stop triggered. Nothing moves price except a transaction. Not information, not sentiment, not fundamentals, the transaction. Every other theory of price movement is ultimately a theory about why people trade. The price itself moves only through the act itself. Now, consider 2 traders: a fundamental analyst who concludes a stock is undervalued and therefore buys, a trend follower who sees a breakout and therefore buys. Their reasoning could not be more different. Their market impact is mechanistically identical. Both place upward pressure on the price. But the nature of that impact is different. The fundamental analyst's impact is what we call convergent. It pushes price towards intrinsic value and then stops. The trend follower's impact is divergent. It pushes price further from equilibrium and invites still more trend followers to act. Different decisions, same transaction, opposite structural effects. These 2 forces, convergent and divergent, are permanently present in every market. Their relative balance in any 2-year window determines whether the autocorrelation of returns tilts positive, tilts negative, or averages out to zero over the full 40-year sample. The zero is their equilibrium. The machine beneath the zero is their competition. Part 1. Zero doesn't mean nothing. How we looked beneath the most quoted statistic in finance and found a machine that should not exist. We did not dispute the number. We simply asked a different question. Instead of measuring what the autocorrelation is, we measured what it does. Instead of compressing 40 years into a single statistic, we watched the statistic evolve. We computed the rolling 2-year autocorrelation of daily returns for the S&P 500 futures contract, advancing the window 1 month at a time from 1986 to 2026. Every calculation used exactly the same methodology. Every calculation used real data. The only thing that changed was which 2 years we were looking at. The full sample statistic said 0. The rolling window told a completely different story. 4 panels. Take a moment with them. Panel A, top left. Full sample autocorrelation function at lags 1 through 20. The bars hover around 0. No systematic pattern, nothing to see. The textbook is correct on this measure. Now look at panel B, top right. Rolling 2-year autocorrelation, computed month by month from 1986 to 2026. The trace does not sit near 0, it oscillates, positive in some periods, negative in others. .com, Black Monday, the GFC, COVID, each crisis is visible as a regime shift. The line is not noise, it has structure. Panel C, bottom left. The actual distribution of rolling values versus what a truly random process would produce. The red dashed curve is independence. The blue histogram is reality. The actual distribution is 1.45 times wider than the random null. The full sample 0 is therefore not the system. It's the system's average, and the average conceals everything important. Panel D, the engine in numbers. 82% of markets reject the independence hypothesis at 95% confidence. Mean dispersion 1.39 times wider than random. Mean full sample autocorrelation function approximately 0. This is the paradox made numerical. Part 2. The coupled spectrum. Part 1 showed the rolling autocorrelation for a single market, the S&P 500. It oscillated. It had structure. The question for Part 2 is whether that oscillation is just one market doing its own thing, or whether all 68 markets are doing it together. To find out, the series assembled every rolling 2-year autocorrelation for all 68 markets into a single image, a heat map. 1 row per market, 1 column per date. The colour tells you which force is dominant. Blue for positive feedback, trending. Red for negative feedback, oscillating. Black for the balance zone in the middle. Take a moment with that chart. Read it in 3 layers. First, the texture. At any given date, the column is not a uniform colour. There are always some blue squares, some red squares, some black. Markets are not all in the same state at the same time. Individual markets retain their own character. The variation is real. Second, the vertical bands. Despite the variation, there are periods where a single colour dominates. Wide red bands appear in the mid-2000s and again from 2018 through early 2020. Wide blue bands appear in the early 1990s and around 2011 to 2013. These bands mean the majority of markets are being pulled towards the same end of the spectrum simultaneously. Something is coordinating them. Third, the transitions. Look at how the bands shift. The red band of 2018 to 2020 does not gradually fade. It ruptures in March 2020, replaced within months by a mixed and then blue-leaning pattern. The calm of the mid-2000s does not slowly transition into the GFC. It holds, then breaks, sharp transitions, not gradual ones. These three layers are the visual signature of what the data will now prove: a permanently coupled system whose spectral position shifts in response to macro forces. Part 3. The Trend Equity Paradox. Everyone in the managed futures industry knows that trend following provides crisis alpha. In the worst equity months, trends tend to make money. The numbers are striking. We identified the 20 worst months for the S&P 500 across 4 decades. In 16 of those 20 months, a diversified trend strategy delivered a positive return. The average equity loss in those months was negative 7.4%. The average trend gain was positive 1.1%. The correlation between trend and equity across those 20 months was negative 0.82. This is well documented. The managed futures community has called it crisis alpha for years. The finding itself is not new. What is new is the explanation. The permanently coupled spectrum revealed in Part 2 is the mechanism that creates crisis alpha. When equity markets enter bear regimes, the spectral state shifts. The heat map shifts red. Negative feedback dominates. Mean reversion increases. The conditions under which simple long-only strategies fall are precisely the conditions under which trend following thrives, because the spectral shift creates the persistent directional moves the trend models capture. Without the coupling, in a truly random and independent market, the crisis alpha would not exist. The coupling is not a context for crisis alpha, it is the cause. One line: the rolling one-year correlation between diversified trend and the S&P 500. The full sample correlation is negative 0.21. Useful diversification on average, but modest. Now watch where the line goes during crisis periods. The marked regions on the chart are bear markets. During those periods, the correlation drops sharply, negative 0.7 on average, negative 0.82 in the worst 20 equity months. Outside bear markets, during bull periods, the correlation is positive 0.07, slightly positive. Trend is not a pure diversifier in normal conditions. The full sample value of negative 0.21 is the average of those two very different states. It conceals a structure. This is the same architecture as the autocorrelation 0 in Part 1. A full sample statistic that looks like one thing and is actually two things in alternation. Part 4. Proving it is not random. The rolling windows, the heat map, the conditional correlations from Parts 1 through 3. These are descriptive tools. They show patterns, but they do not formally rule out the possibility that a random process produced them. Part 4, however, requires a different standard. The variance ratio test provides it. The logic is simple. If a market is truly random, then a move that starts on Monday should have no tendency to continue or reverse by Friday. Weekly moves should be predictable from daily moves in a specific mathematical ratio. If weekly moves are consistently larger than the daily moves predict, something is making moves persist. Positive feedback above 1 on the variance ratio. If weekly moves are consistently smaller, something is making moves cancel out. Negative feedback below 1. Exactly 1 is a coin flip. We applied the variance ratio not once but in a rolling fashion, exactly as we had done with the autocorrelation. The result confirmed the spectral structure via a completely independent mathematical test. During positive feedback regimes, the variance ratio is above 1. During negative feedback regimes, it is below 1. The full sample value sits at 0.91, close to 1, which looks like randomness, but that full sample value decomposes into 1.13 during breakout periods and 0.28 during flat periods. 3 independent tests: rolling autocorrelation, conditional correlation with equities, variance ratio. All 3 reveal the same spectral structure. The random walk is not an approximation that breaks down occasionally, it is wrong. Same 68 markets, same 40 years, now coloured by variance ratio instead of autocorrelation. Blue above 1, red below 1. The structural pattern is the same as the ACF heat map from part 2. Same periods, same colours, different mathematical test, identical answer. 3 tests, 3 different measurement approaches, 1 architecture. The coupled spectrum is a feature of how markets operate, not a measurement artefact. Part 5. The structure persists. The evidence from parts 1 through 4 kills 2 possible explanations and confirms a third. State 1. The structure does not exist, and what we measured is noise. 3 independent tests, all showing the same spectral architecture across 68 markets and 40 years, rules this out. State 1 is therefore dead. State 2. The structure exists but is decaying. The adaptive markets hypothesis, the most sophisticated version of the efficiency story, makes a specific prediction. Capital should flow towards a signal. Models should crowd the trade. Each decade should show less structure than the last. The oscillation amplitude should shrink measurably over 40 years. Now, we tested this directly, divided the sample into 4 decades, measured the oscillation amplitude within each. Under State 2, the amplitude should shrink decade by decade. It did not. The oscillation amplitude is statistically indistinguishable across all 4 decades. The 2016 to 2026 decade shows the largest amplitude. State 2 is dead. State 3 is confirmed. The feedback mechanism is structural, not exploitable away. 4 bars, 1 per decade, height equals oscillation amplitude. Under State 2, these bars should be declining, each decade smaller than the last, the signal being arbitraged away. Look for that pattern. It's just not there. The bars are flat. The 2016 to 2026 bar is actually the largest of the 4. 40 years of adaptive capital have not moved the needle. The structure is not an anomaly being corrected. It is a structural feature of how markets process information, and it shows no signs of changing. Part 6. The fingerprint. Parts 1 through 5 treated the 2 forces as roughly equal partners, differing in direction but similar in character. Part 6 finds that this is wrong, or rather incomplete. When you measure the 2 forces separately, decomposing each market's return history into individual positive feedback episodes and individual negative feedback episodes, and then measuring the duration of each, a finding emerges that changes how you understand every asset class. The 2 forces are not symmetric. Positive feedback episodes, the trending periods, last substantially longer in some asset classes than negative feedback episodes, and the ratio between them varies dramatically across asset classes. In livestock, a typical positive feedback episode lasts 189 trading days. A typical negative feedback episode lasts 84 days. The ratio is 2.2 to 1. In grains, the ratio is 2 to 1. In softs, 1.5 to 1. In fixed income, 1.3 to 1. In equities, the ratio is 1 to 1. The 2 forces are roughly symmetric. In foreign exchange and energy, the ratio inverts. Negative feedback episodes last longer than positive ones. The same 2-force structure operates in every asset class, but the ratio between the 2 forces is the fingerprint that distinguishes each one. Find the 1 line, on the chart. That is a symmetry point where the two forces last equally long. Equities sit close to 1. The two forces are roughly balanced in equity index futures. Now look to the left, livestock and grains. The ratio is above 2. Positive feedback episodes last more than twice as long as negative feedback ones. These are the markets where trend following has historically been most reliable because the underlying structure gives the trending force more time. Now look to the right, energy and foreign exchange. Below 1. Negative feedback episodes last longer, mean reversion has more time to operate. This asymmetry is not a random quirk, it is a structural property of each asset class that emerges from the underlying agent population and how that population interacts with price. A trend model that ignores the fingerprint is applying the same calibration to markets that operate at fundamentally different frequencies on the two sides of the spectrum. Part 7 shows why that matters. Part 7. The Paradox. 6 episodes of evidence have established a persistent, structural, asset class spanning system of positive and negative feedback. The logical conclusion should be divergent strategies work, have always worked, and will continue to work. The case for trend has never been stronger. Then we built the strategy and ran the numbers. The feedback amplitude is stable or rising across 4 decades. The spectral oscillation is present in every decade. The structure is confirmed by 3 independent tests. And yet, a simple diversified trend strategy applied to the same 68 markets over the same 4 decades shows a clear pattern in the sub-period analysis. The strategy's Sharpe ratio in the first decade, 1986 to 1995, was 1.71. By the most recent decade, 2016 to 2026, it had fallen to 0.5. The signal is getting stronger, the simple strategy is getting weaker. These two facts appear to contradict each other, but they don't. But reconciling them requires understanding 3 forces that have been operating in parallel. The first is regime suppression. As more capital deployed systematic trend-following strategies, the profitable regimes became more crowded. The signal did not go away, but more capital competed for the same opportunities. The second is short-side impairment, which episode 8 investigates directly. The third is horizon gradient, where the signal has shifted to longer and shorter timeframes than the simple model monitors. The structure persists. The simple systematic strategy does not. The paradox is not a contradiction, it is a measurement problem. 2 panels. Left panel, ACF oscillation amplitude by decade. Blue bars, 0.049 in the first decade, rising to 0.056 in the most recent. The signal is getting stronger. Right panel, strategy performance by decade. Red bars, Sharpe ratio of 1.71 in the first decade, falling to 0.50 in the most recent. The simple strategy is getting weaker. Same 68 markets, same 40 years. Left panel, the structure. Right panel, what a simple symmetric strategy earns from that structure. The structure and the strategy are diverging. Something is standing between the signal and the returns. Episodes 8 and 9 identify what it is. Part 8. The escalator and the elevator. Why long trades and short trades require independent calibration and what the data reveals when you test it. Part 7 identified short-side impairment as one of the 3 forces suppressing simple trend returns. This episode investigates it directly. The starting point is one of the most robust findings in empirical finance. Bull markets and bear markets are not symmetric. Lund and Timmerman, studying 2 centuries of US stock data, found that bull markets average approximately 46 months in duration, bear markets average 14 months. Prices take the escalator up and the elevator down. This is not an anomaly, it's a direct consequence of the agent population. The global capital base is overwhelmingly long biased. passive funds, pension funds, endowments, buybacks. Structurally long capital exceeds structurally short capital by roughly 20 to 1. During uptrends, convergent impact builds gradually against the trend. Value investors trim, rebalancers sell winners, profit takers exit. The two forces stay roughly balanced. The escalator moves slowly. During downturns, it is different. Convergent impact overwhelms the stabilising forces. Stop losses trigger margin calls cascade. Forced sellers amplify the move. The elevator drops fast. If bull markets last 3 to 5 times longer than bear markets, and if the two directions operate at different frequencies, then a symmetric trend model applying the same look-back parameter to both long and short signals is structurally misaligned with at least one side at all times. When you give the short side a shorter look-back calibrated to bear market duration rather than the same look-back used for longs, the apparent death of short side alpha is not confirmed. It was not dead, it was invisible to a symmetric lens. Find the pattern in those bars. Long side performance has been the more consistent contributor across all 4 decades. The long trend has been the escalator. Short side performance is where the divergence appears. The symmetric model shows declining short side contribution across the decades. But when you recalibrate the short side lookback to match the typical duration of negative feedback episodes, shorter lookbacks align to the faster downward velocity, the short side signal recovers substantially. So the short side is not dead. It operates at a different frequency than the long side. A symmetric model cannot see both frequencies simultaneously. Separate calibration recovers what the symmetric model misses. Part 9. The Verdict. This series began with a number, the near-zero autocorrelation that everyone in quantitative finance takes as confirmation of the efficient market hypothesis. 9 episodes later, the evidence is in. The series encountered 3 zeros. The first was the autocorrelation, a full sample value of negative 0.001 across 68 markets, concealing a system that oscillates between positive 0.035 in positive feedback periods and negative 0.038 in negative feedback periods. The second was the trend equity correlation, a full sample value of approximately negative 0.16 that decomposed into positive 0.07 during bull markets and negative 0.47 during bear markets. The third was the variance ratio, a full sample value of 0.910 that decomposed into 1.13 during donkey and breakout periods and 0.282 during flat periods. 3 different statistics, 3 different tests, 3 different episodes, 1 spectral structure. Each zero conceals the same architecture, 2 opposing forces that cancel when you average across time. The full sample statistic tells you the system's centre of gravity. It tells you nothing about how the system actually operates. 3 panels, same visual structure in each. In each panel, the full sample statistic sits in the middle, grey, unremarkable, the kind of number that appears in textbooks and gets accepted as confirmation of the random walk. Flanking it on either side are the 2 regime values, green for the positive feedback state, red for the negative feedback state. Left panel, autocorrelation, full sample negative 0.001, positive feedback state positive 0.035, negative feedback state negative 0.038. Centre panel, trend equity correlation, full sample negative 0.16. Bull markets positive 0.07, bear markets negative 0.47. Right panel, variance ratio, full sample 0.910, breakout periods 1.13, flat periods 0.282. Same architecture, 3 different tests. The zero is always the weighted average of two very different states, and the states are what determine everything that matters for trading. Here is the line I want you to take away from this series. The zero is real, but it is the weighted average of two opposing forces that cancel when you compress them into a single number. Beneath the zero lies a machine. 9 independent lines of evidence point to the same architecture. This is what the data shows. Sit with that. Every major framework in quantitative finance, the efficient market hypothesis, the random walk, the capital asset pricing model, value at risk, these are all built on the premise that the near zero autocorrelation of daily returns means the past is irrelevant. The past is not irrelevant. It is concealed by averaging. The structure has been present for 4 decades. It has not decayed. It has not been arbitraged away. It is not a measurement artifact. 9 independent lines of evidence across 3 different mathematical tests, all 68 markets and 41 years of data point to the same conclusion. The machine beneath the zero is real, and it has implications for everything from how you calibrate a trend model to how you understand what crisis alpha actually is. 4 direct implications for anyone who trades or manages capital. First, the full sample statistic is not the signal. The autocorrelation, the trend equity correlation, and the variance ratio all average to values that look like noise, but they are not noise averaged. They are structure averaged. The signal lives in the conditional decomposition, not the aggregate. Full sample statistics that look unremarkable can conceal dramatically different regime states. Second, crisis alpha is structural, not coincidental. The spectral shift that occurs during bear markets is the mechanism behind trend following's negative equity correlation in crises. It is not a lucky period, it is not a historical artifact, it is a structural consequence of how the two forces interact during periods of negative feedback dominance. It cannot be arbitraged away without changing market microstructure itself. Third, asset classes have different fingerprints, and calibration should reflect them. Livestock trend differently from equities, energy trends differently from bonds. The duration asymmetry revealed in Part 6 means that a model treating all asset classes identically is misaligned with at least some of them at all times. Understanding the fingerprint of each class is a structural requirement, not an optimization preference. And fourth, the short side requires independent calibration. Symmetric trend models are structurally misaligned with the short side because bear markets operate at a different frequency than bull markets. Giving the short side a shorter look back, calibrated to the actual duration of negative feedback episodes, recovers a signal the symmetric model obscures. This is not parameter fitting, it is structural alignment. 6 key things to take from the Fractals of Finance Phase 2. 1. The zero is not nothing. The full sample autocorrelation of negative 0.001 conceals a permanently coupled system oscillating between opposing feedback regimes. The average is the weighted sum. It tells you the system's centre of gravity, not how it operates. 2. The system is coupled, not independent. All 68 markets oscillate along the same spectral axis simultaneously. Individual market character is retained, but within a shared structural framework driven by the same macro forces. 3. Crisis alpha is mechanistic. The coupled spectrum creates the conditions under which trend following's negative equity correlation appears in bear markets. It is not coincidence, it cannot be diversified away, it is structure. 4. The feedback structure has not decayed. 40 years of adaptive capital, algorithmic trading, and quantitative finance have not reduced the oscillation amplitude. The mechanism is structural, not exploitable away. 5. The two forces are asymmetric. Positive feedback is gentler and more sustained. Negative feedback is more intense and briefer. The ratio between them varies by asset class and is the fingerprint that distinguishes each one. And 6. The paradox resolves with better calibration. The divergence between a signal and simple trend returns is not evidence that trend following is dead. It is evidence that symmetric models are misaligned. Separating long and short lookbacks, conditioned on spectral state and asset class fingerprint, recovers a signal the simple model misses. Every part of this series is published in full on the ATS Trading Solutions website. 9 episodes, each one building directly on the last. Read them in order. The links are in the description below. Part 1. 0 doesn't mean nothing. Part 2. The coupled spectrum. Part 3. The trend equity paradox. Part 4. Proving it is not random. Part 5. The structure persists. Part 6. The fingerprint. Part 7. The paradox. Part 8. The escalator and the elevator. And finally, Part 9. The verdict. Start at Part 1. Read them in order. Each episode builds on the last. Dispatches from the Outpost is a video series from ATS Trading Solutions where I walk through our published research, take deep dives on specific ideas, and challenge the conventional wisdom that holds most traders back. Every dispatch comes with a full written summary on the website. Watch the video, read the series, go as deep as you want. Subscribe on YouTube so you don't miss the next one. That is the Fractals of Finance Phase 2. The machine beneath the zero is real. It has been running for 4 decades without decay. Phase 1 proved the fingerprint exists. Phase 2 shows you what it does. Every crisis alpha trade trend following has ever made is a consequence of that machine. Every frustrating period of drawdown is a consequence of symmetric models being misaligned with an asymmetric structure. Understanding this does not just explain the past, it changes how you build the strategy. The full series is at atstradingsolutions.com. Read it in order, start at Part 1. What you are looking at is not a prediction, it is a structural understanding of a system that has been running in plain sight, hidden behind the most quoted number in finance. Until next time, stay in the process.